Stop looking at the S&P 500. Stop obsessing over the Federal Reserve's interest rate. Plot. Put down the earnings reports for Nvidia and Microsoft. They are irrelevant. The real story, the single narrative that will define the survival of the global economy for the next decade, isn't happening on Wall Street. It happened 72 hours ago in the corridors of power in Mexico City, and the mainstream media is too terrified or perhaps too compromised to report it accurately. While you were sleeping, while you were distracted by political theater in Washington, the global supply chain was effectively decapitated. Mexico, the planet's undisputed king of silver production, has just detonated the nuclear option. This isn't a minor policy shift. This isn't a slight increase in royalties. This is the Mexican government flipping the entire global chessboard. They have effectively nationalized the supply of the single most critical element for the 21st century digital economy. We are staring at a spot price of $92 today, January 20th, 2026, and I am here looking you in the eye to tell you that $92 is a joke. It is a hallucination. It is a price from a world that no longer exists. What we are witnessing right now is not a bubble. It is the beginning of a liquidity squeeze so violent, so structural, that it will make the 1970s oil crisis look like a minor intraday correction. Behind closed doors, Tesla's production lines are grinding to a catastrophic halt. Apple's procurement officers are scrambling in a blind panic. The COMEX vaults in New York are bleeding dry at a rate that is mathematically impossible to sustain. The smart money, the hedge funds, the insiders, the sovereign wealth funds, they know the truth. They know that $150 per ounce isn't a target to sell at, it's the floor. It is the minimum price required to prevent the complete collapse of American technological manufacturing. Welcome to the new reality where paper money means nothing and physical resources mean everything. Let's follow the money. To understand the panic we are seeing today, we have to rewind. This didn't happen overnight. It was a calculated three-stage checkmate executed by the Mexican administration under President Claudia Sheinbaum. Phase 1. The warning. On December 5, 2025, Sheinbaum stood before the Mexican Congress and announced a review of all strategic mineral concessions. That was the diplomatic signal. The market ignored it. Phase 2. The trap. 1 week later, the Secretary of Economy dropped the hammer. Any mining project seeking expansion or export permits must demonstrate majority Mexican ownership. Read that again, not a tax ownership. They told foreign miners, Canadian-American, that if you want to dig in our soil, we own the mine. If you don't like it, get out. Phase 3, the kill shot, January 7, 2026. Just 2 weeks ago, the Strategic Mineral Sovereignty Framework was unveiled. This classifies silver alongside lithium as a matter of national security. Here is the kicker. Under this framework, every single ounce of refined silver leaving Mexico requires direct government approval, and the law explicitly states that domestic needs, Mexican factories, Mexican solar plants, must be satisfied before a single gram is exported to the United States. Why did Mexico do this? Context matters. Remember February 2025. Donald Trump announced 25% tariffs on Mexican auto imports. He tried to bully Mexico into submission regarding immigration. It crushed the Mexican auto sector. But Mexico realized they couldn't win a trade war with money. They're too small. So, they decided to fight a war with physics. They weaponized scarcity. They looked at the U.S. supply chain and realized America has zero strategic silver reserves. Zero. The U.S. government sold them all decades ago. Mexico realized that while they need American dollars, America needs Mexican silver to exist as a technological superpower. Trump played checkers. Sheinbaum is playing 4D chess. This is retaliation disguised as resource policy. Now let's look at the victims. This is where the story shifts from politics to a financial thriller. American industry is walking into a buzzsaw. Let's talk about Elon Musk. Tesla consumes approximately 38 million ounces of silver annually across its EVs and solar city panels. Historically, they bought this through long-term contracts with mines. In Mexico, those contracts are now effectively void. Mexico is reviewing them for national interest compliance. Tesla's procurement teams are currently bypassing the mines and trying to buy physical delivery from the COMEX in New York and the LBMA in London. But here's the problem. Apple is doing the same thing. Apple sells 220 million iPhones a year. Every single one needs silver for circuit boards and connectors. That's 15 million ounces a year. Then you have Samsung. Their Texas battery plant is short 11.6 million ounces for Q1 production. Do the math with me. It's brutal. Mexico produces 186 million ounces a year, 23% of the world's supply, but 70% of silver is a byproduct of copper, zinc, and lead mining. You cannot just ramp up production. To get more silver, you have to dig more copper, and copper mines take 10 years to permit and build. Supply is inelastic. It is fixed. So you have Tesla, Apple, Samsung, and First Solar all fighting over a shrinking pie. They are price-inelastic buyers. If silver goes to $150, does Tesla stop making cars? No, silver is a small fraction of the total car cost. They will pay it. They have to pay it. This creates a doom loop. Mexico restricts supply. Prices rise. Corporations panic buy. Inventory vanishes. And prices go vertical. We are seeing iceberg orders all over the market right now. Massive buy orders hidden from the public book, sweeping up every available bar. This isn't speculation. This is survival. This brings us to the belly of the beast, the financial markets, the COMEX in New York. This is where the fraud is finally being exposed. For decades, the price of silver has been suppressed by the paper market futures contracts that trade hundreds of times more volume than there is actual physical metal to back them. But you cannot build a Tomahawk missile with a paper contract. You cannot build a solar panel with a promissory note. The COMEX vault is being drained. Registered silver, the metal that is actually available for delivery against futures contracts, was 370 million ounces in 2021. Today, it is hovering around 280 million ounces. During high-demand periods like this week, it is dropping by approximately 1 million ounces per day. At that rate, the vault is effectively empty by June, but we won't make it to June. We have the March delivery window coming up. February 1st to February 20th. There are 145,000 open contracts for March. Each contract represents 5,000 ounces. That is a total potential demand of 725 million ounces against a vault that holds 280 million. Even if only 20% of those contract holders stand for delivery, that is 145 million ounces demanded instantly. That is half the vault gone in a single month. When this happens, COMEX faces a binary choice, and both options are explosive. Option A, they default. They admit they don't have the metal and force investors to settle for cash. This destroys confidence in the market and sends the real physical price to the moon. Option B, they try to source metal from the open market, but where Mexico is closed. Peru is facing strikes. Chile is struggling. The short squeeze is inevitable. The paper shorts, the banks that bet against silver, are trapped. They are staring at unlimited liability. Let me leave you with this final thought. The world you grew up in, the world of free markets, where you could buy anything if you had enough dollars, that world ended 72 hours ago. We are entering the era of resource nationalism. Mexico did it with silver. Indonesia did it with nickel. Who is next? Will China ban rare earth exports? Will Russia cut off palladium? In this new era, paper assets are liabilities. Your stock portfolio is a claim on companies that cannot operate without resources they can no longer secure. Your bond portfolio is a claim on governments that are printing currency to buy commodities at hyperinflationary prices. Your bank account is denominated in dollars that are being debased to fund wars over these very resources. The only assets that hold value in a resource war are the resources themselves: physical gold, physical silver, commodities you can touch, hold, and own without counterparty risk. If you are sitting on cash, waiting for silver to pull back to $70, waiting for a better entry point, you are waiting for a train that has already left the station and blown up the tracks behind it. The dip isn't coming. The buyers aren't retail investors like you and me anymore. The buyers are Tesla. The buyers are First Solar. The buyers are the People's Bank of China. These are entities with deeper pockets than God, and they are panic buying. $150 is not speculation. It is the new equilibrium. It is the repricing of reality. Mexico just drew the line in the sand. They said, our resources, our rules, and America has no answer except to pay the price. the question isn't whether you should buy silver. The question is, when the factories stop and the supply chain breaks, what is your paper money actually worth?
October 2025. A suffocating tension hangs over the APEC summit in Kuala Lumpur. The world holds its breath as Donald Trump and Xi Jinping face off in a high-stakes standoff. Retail investors, the crowd we call the small fry, bet their entire portfolios on a chaos scenario, expecting a geopolitical explosion to send precious metals into the stratosphere. But the moment the handshake was televised, a massacre ensued. And it didn't start with gold. Silver was the first victim led to the chopping block. While all eyes were fixed on gold, silver, the poor man's gold that serves as the industrial heartbeat of the planet, was hammered down by over 5% in a single New York trading session. This wasn't a standard correction, it was a calculated free fall. Retailers fled in a panic as massive red candles sliced through every technical support level. They fell for the media trap, the narrative that the Kuala Lumpur Peace Accord signaled an end to instability, stripping silver of its reason to exist at premium prices. In an instant, silver hit its peak and was violently dragged down to the $30 zone. A historic fever turned into a bloodbath on the COMEX floor. Why would a peace deal be a death sentence for silver? The answer isn't in the Bloomberg headlines. It's buried in a classified memorandum, the Kuala Lumpur Joint Arrangement. A backroom deal turned the white metal into a sacrificial pawn for a higher power play. While the paper price was being decimated on your screen, behind the curtain, physical silver was being drained from vaults at a terrifying velocity. Smart money was casting a massive net, using the crowd's misguided euphoria as bait. To understand why silver was executed to set the precedent, we must look at the core of the November 4, 2025 Kuala Lumpur Agreement. One clause sent shockwaves through the elite. China agreed to lift export controls on rare earth elements, the oxygen for the U.S. defense and semiconductor industries. In exchange, Washington greenlit the export of NVIDIA H200 AI chips to Beijing. Think logically. Silver is the essential component in solar panels and EVs, sectors China dominates. When trade risks were neutralized by this chips for minerals swap, the paper-driven need to stockpile silver for supply chain protection vanished. The retail crowd panicked, believing the green energy era was over under Trump. But what is the truth? The whales behind the major hedge funds were using iceberg orders, massive buy orders broken into tiny pieces to hide their footprint, to quietly accumulate silver at this massive discount. They are preparing for a scenario you haven't been told, the explosion of next-gen AI infrastructure, which consumes 3 times more silver than legacy technology. This is a global shareholder blood transfusion. They suppressed the price with political noise to strip the weak hands of their assets, preparing for the spring to coil before the AI demand hits an unbreakable ceiling. Silver was the spark. Gold was the forest fire. Immediately after silver was pushed into the abyss to trigger a domino effect, gold, the king of assets, was next on the hit list. To understand why gold collapsed from its $4,500 peak to below $4,300, we have to follow the money along a trail that leads straight to a man the public barely understands, Scott Kenneth Homer Bessent. It is no accident that Trump chose a former George Soros protege as his Treasury Secretary. Bessent is not a politician. He is a market architect, a master of the invisible cage. He spent decades learning how to break currencies and manipulate global flows from the shadows. Now he's been given the keys to the most powerful weapon in the world, the U.S. Treasury. Investigative data reveals that upon taking office, Bessent initiated Operation Dollar Fortress. This wasn't just a policy, it was a declaration of war against hard assets. They didn't just sell gold, they used the weaponized interest rate to make gold feel like a burden. They created a reality where holding a bar of gold felt like holding a stone while the dollar fortress was handing out bricks of risk-free cash. This is a nation-state-level liquidity swap. You are watching a great betrayal of the gold standard dream. The U.S. needed China to keep buying its debt to fund the $38.1 trillion deficit, and China needed the U.S. to ease the AI chip blockade on NVIDIA. Gold and silver were suppressed to serve as the industrial grease for this secret deal. They are manufacturing an illusion of stability, a temporary peace designed to trick the crowd into thinking the era of safe havens is over. They want you to believe the dollar has been fixed so they can accumulate the gold you're throwing away. They are burning the white and yellow metals to keep the furnace of the debt-based system running for one more year. Let's perform a forensic autopsy on the Trump 2.0 economic engine. Scott Bessent is driving the 3-3-3 policy, 3% GDP growth, reducing the deficit to 3%, and boosting oil production by 3 million barrels a day. It sounds like a dream for the dollar and a nightmare for gold, right? But look at the hard reality. U.S. national debt has hit $38.1 trillion. Every 100 days, the U.S. adds another $1 trillion in debt. A 4.5% interest rate means the government is paying a staggering amount of interest annually, a figure that now exceeds the entire national defense budget. The strong dollar is a hall of mirrors sustained by temporary political truces like Kuala Lumpur. Trump wants a strong dollar to force other nations to buy American, but the debt system cannot survive high interest rates forever. This is an irreconcilable internal contradiction. Silver and gold are currently like a spring being compressed by a titanic force called monetary policy. The harder the compression, the more violent the eventual release. When the Kuala Lumpur Agreement inevitably frays, and it will as new tariff barriers rise in 2026, this spring will unleash its full energy. Do not be deceived by the red candles on your COMEX screen. The plunge of silver to the $30 zone and gold below $4,300 is not the end. It is the starting gun for a massive financial restructuring. The smart money is cleaning the market, flushing out the weak hands to prepare for an unstoppable surge. When the faith in artificial peace evaporates and the $38.1 trillion debt burden begins to choke the U.S. economy, the world will realize that no handshake can replace the intrinsic value of physical metal. The next target for silver isn't just the old high, it's the $50 to $70 range, while gold will set its sights on the $5,000 milestone. A final word of advice: do not sell your soul at this technical support level. The whales are waiting for your panic to complete their final accumulation. You must choose. Be a victim of the Kuala Lumpur Compact or a partner to gold and silver on their journey to a new peak. The decision is yours. Hold your ground. The spring is about to snap. You are witnessing the impossible, a paradox that defies the very laws of financial physics. Last night, Washington dropped a bombshell. U.S. GDP hit 4.3%, the strongest growth in 2 years. According to every mainstream economic textbook, this should have been the death blow for gold. The dollar should have soared to the heavens, and gold should have been crushed under the iron heel of rising interest rates. And for exactly 15 minutes, the script played out perfectly. Gold went into a free fall, shedding $60 in a guillotine move that wiped out thousands of retail buy orders. The crowd fled in a panic, convinced that the $4,500 bubble had finally burst. But look closer at the tape. Why, at that exact war zone of 4,500, did a massive, silent, and cold-blooded buying force swallow every single sell order? Why, when the GDP numbers looked their brightest, did gold stage a violent reversal, piercing through the 4,500 ceiling like an unstoppable arrow? The answer does not lie in Washington. It lies in Beijing. Last night, while the world was hypnotized by America's hollow GDP figures, the Eastern Dragon was executing a move of total subversion. Welcome to this special investigative report by News Finance. I am your guide through the shadows of the global money flow. Let me perform an autopsy on that 4.3% GDP figure for you, so you can see the rot inside. As a hedge fund manager, I don't look at headlines. I look at the internal organs of the report. The reality is grim. American consumer confidence is crumbling. Durable goods orders, the very backbone of industrial production, have plummeted by 2.2%. So why is the GDP so high? Because the U.S. government is spending money like there is no tomorrow just to maintain a veneer of prosperity. This isn't growth, it is a forced blood transfusion from public debt. But while the retail crowd was being distracted by these synthetic numbers, smart money was tracking a different ghost, the People's Bank of China. Satellite data and customs reports reveal a chilling truth. China has been stealthily accumulating gold for 13 consecutive months. Even as gold hit all-time highs, they did not stop. Why? Because Beijing has looked through the smoke and mirrors of America's $36 trillion debt trap. Follow the money. Last night, when gold dipped into the 44.50 zone, massive iceberg orders were triggered. These were not the orders of retail traders. These were sovereign reserve orders. China is trading paper dollars for physical gold bullion. They are building a great wall of gold to shield their economy before the American financial storm makes landfall. And China isn't just buying gold, they are executing a scorched earth strategy. In the last 48 hours alone, they dumped over $11 billion in U.S. Treasury bonds. This is a mass exodus. When your largest creditor starts throwing your IOU notes into the trash, you know exactly what is coming next. Connect the dots, and you will see a terrifying picture of the collapse of the old world order. In the West, Donald Trump is creating an unprecedented political earthquake. He has openly challenged the Federal Reserve, the institution once considered the holy sanctuary of currency independence. His message is blunt: either pivot and cut rates to save the economy, or step down. When the Fed loses its independence, the U.S. dollar is no longer a safe haven. It becomes a political pawn, and that is the spark for gold's fury. In the East, Beijing is weaponizing this instability. They are leading the BRICS nations to create a new settlement system. Their strategy is simple: the weaponization of gold. They know that U.S. public debt has passed the point of no return. The interest payments on U.S. debt now exceed the entire national defense budget. This is a spring compressed by desperation. China is standing on the other side of the battlefield, quietly gathering every ounce of gold possible for the moment that spring finally snaps. Imagine this: when the dollar is politicized, when U.S. debt explodes, and when China introduces a currency backed by gold, the $4,500 mark today will look like a quaint starting point. We are in a war without bullets, where the weapons are not nuclear missiles, but 24-karat gold bars. They, the manipulators, want you to believe the dollar is still strong, so they can exit their positions safely. But we, the smart investors, must see the current flowing beneath the surface. The $4,500 barrier has been conquered. But do not misunderstand me. This is not the time to celebrate or take early profits. Technically, we have entered a vacuum zone. There is no more historical resistance. Above us is an open sky. When the algorithms of the major banks fully recognize the structural collapse of the dollar, a mass buy-stop sequence will be triggered. This will be a short squeeze of biblical proportions, incinerating every short seller on the planet in an instant. The next target, 4,600, 5,000, it is no longer science fiction. With China aggressively increasing its position and Washington's policies accelerating the erosion of trust in the dollar, we are entering a new financial epoch, an era where gold is no longer jewelry, but the only life jacket on the Titanic of fiat money. Here is my final warning to you. Do not be the person standing on the tracks when the high-speed train arrives. Last night, thousands lost everything because they believed in that 4.3% GDP lie. They sold their gold at $44.50, and now they are forced to buy it back at $45.20 with bitter regret. Do not sell the insurance of your life for a few minor tremors. Follow the footprints of the Eastern Dragon and the smartest money in the world. The market is never wrong. Only those who misread it pay the price. The great game has only just begun. Which side will you choose? The side of paper notes losing their soul, or the side of the eternal metal? Don't forget to subscribe and turn on notifications, because in the coming days, this battlefield will only get more brutal. I will be here with you, stripping away the masks of Wall Street one by one. I'll see you in the next investigation. Stay sharp and hold your ground in this financial storm. While you were enjoying the warmth of your family on Christmas Eve, a life and death chessboard was flipped on the other side of the globe. Washington has just made its most reckless move in a decade. The U.S. Navy forcibly boarded a Chinese-linked vessel in international waters to tighten the noose around Venezuela. The reaction from Moscow? Vladimir Putin did not hesitate. An emergency communique from the Kremlin was just released, affirming that Russia will protect Maduro at any cost. Meanwhile, Beijing remains silent. But in the world of giants, China's silence is the sound of a tsunami building offshore. All of these events are converging toward a single explosive point that no one on mainstream television dares to mention: the silver market. Why would a naval skirmish change the value of the assets in your pocket forever by tomorrow morning? Why, as superpowers draw their swords, does the silver price on your chart sit suspiciously still at $71.94? I am a financial investigative journalist, and tonight I will expose a conspiracy. Smart money is weaponizing this chaos to orchestrate a raid on the global financial system. We are entering Ghost Week, where an $8 price gap is waiting to wipe out the naive. Don't look away from the screen. This is no longer a forecast. This is a forensic field investigation into the largest liquidity explosion in modern history. Let me explain why the silver price has been eerily flat for the last 24 hours. In the world of hedge fund management, we call the period between December 26th and January 2nd Ghost Week. Think about who controls the market on a normal Tuesday. It's the senior risk managers at JP Morgan, the head traders at Bridgewater, and the elite algorithmic desks in London and Hong Kong. But right now, they aren't there. They're skiing in Aspen or lounging on yachts in St. Bart's with their families. They've powered down their terminals and handed the keys to the castle to a skeleton crew, junior traders, interns, and maintenance algorithms running on low power mode with one single instruction: do nothing until the boss gets back in January. This creates a lethal phenomenon, the liquidity vacuum. Trading volume drops by 90%. Imagine the silver market is a room filled with gasoline fumes, but no one is standing guard. On a normal day, the ice protecting the market is 10 meters thick. A billion-dollar sell order barely leaves a scratch because thousands of limit orders are waiting underneath like a safety cushion. But during Ghost Week, that ice is paper thin. The walls of buy orders have been pulled. If a massive buy order hits the tape tomorrow morning, perhaps from a Chinese sovereign wealth fund seeking retaliation for the U.S. blockade, the price won't tick up. It will teleport. It will gap from $72 straight to $80 in 60 seconds. Why? Because there is no one there to sell to them. The sellers are busy opening Christmas presents. Now, let's connect the logical dots they don't want you to see. Silver isn't just jewelry, it is a war metal. When the US boarded that Chinese ship, they triggered a chain reaction. The macro algorithms of the world's largest funds are programmed with one ultimate command: sell risk, buy havens. Usually, the US dollar is the haven, but look at the DXY, dollar index. It's at a 12-week low. Why? Because the dollar is the very weapon being used by the US to enforce the blockade. The world, led by the BRICS bloc, Moscow, in Beijing, no longer trusts the dollar. They are hunting for an asset that cannot be frozen and cannot be printed. That asset is silver. Then comes the knockout punch. The Federal Reserve has officially waved the white flag. Governor Christopher Waller admitted that inflation is stuck at 2.7%, yet they are still forced to cut rates. Why would they commit economic suicide? Because the $36 trillion US debt is so massive that if they don't lower rates, the government defaults instantly. This is the most terrifyingly bullish signal for silver I have seen in my career. Silver thrives in an environment of negative real rates. When you hold dollars, you are losing purchasing power every second. Smart money knows this. That is why the dollar index is collapsing during the holidays. They are fleeing the dollar before the new year even begins.
On December 23rd, just before the holiday break, a silent raid took place at the COMEX vaults. 1.4 million ounces of silver at the Asahi refining vault evaporated overnight. You can print more dollars, but you cannot print 1.4 million ounces of physical silver. Look at the scale. A total of 2.2 million ounces of liquid silver left the system in just 24 hours. Why does this matter for Ghost Week? Typically, when the price hits an all-time high of $71.11, inventory should increase because people want to sell and take profits, but the opposite is happening. The price is at the ceiling, but the vaults are empty. This is the textbook definition of a cornered market. The entities withdrawing this silver don't care about a price of $72 or $75. They are terrified that by January there will be no silver left to own. They are pulling physical metal out of the system to ensure the survival of their technological and military supply chains. And here is the anchor for the price. Silver in Shanghai is currently trading at $77, while New York is at $72. That $5 spread is a massive magnet. Tomorrow, when the New York market opens with razor-thin liquidity, the Shanghai magnet will pull New York's price vertically. Any attempt to push the price below $70 will be devoured instantly by arbitrage bots. Do not let the stillness of tonight fool you. The silver market is a coiled spring compressed to its absolute limit. Tomorrow morning, December 26th, when the opening bell rings, we will witness something unprecedented. I am forecasting a gap up of approximately $8. We could see silver open at $80 and never look back. A final warning: if you are using high leverage, stop. During Ghost Week, the market can whip down to $68 for 1 second to liquidate your account before skyrocketing to $80. Don't get left behind because of a technical tremor. 2025 was just the tutorial. 2026 is the boss level, where silver inventory runs dry, where the BRICS currency is born, and where the Fed officially surrenders to inflation. Hold on to your physical ounces. Do not sell early. Do not let Moscow, Beijing, or Washington steal your position in this game. Be the intelligent observer, follow the footprints of the smart money, and enjoy your holiday with the confidence of someone who has seen through the matrix. Don't forget to like and subscribe for the most urgent investigative reports on global capital flows.